Welcome back, guys. In today's video I want to mainly talk about the differences between financial accounting and managerial accounting. In my previous video, there's a video I did where I explained what the two mean. So this question is common. It's normally asked in accounting, normal accounting 1, and it's normally in topic 1 of accounting 1. So this video is mainly for the differences. They normally ask the differences between financial accounting and managerial accounting. So for the purposes of learning, I can recap very fast. Financial accounting is basically reporting of business performance. It deals with financial statements like the balance sheet, the income statement, which people normally call the profit and loss. Then managerial accounting is just for the day-to-day running of the business. So for example, managerial accounting deals with cash flow reports. Those are what they call management reports. So for purposes of time, let me go straight to the differences. There are quite many. These are the major differences between financial accounting and management accounting or managerial accounting. The difference number 1 is the users. Financial accounting the main users of financial accounting are external users. I'm going to come and explain about the users of accounting. Then the management accounting, the users are internal. What do they mean by users? Users are people who use the financial information or the accounting information. We have external users and internal users. Internal users are people who work within the organization. Then external users are people who are outside the organization. So with financial accounting, it's mainly for external users. For example, an example of an external user, I can give you the public, the media, the investors. Those are external users. Then internal users, for the purposes of management accounting, the employees, middle, top level management. Those are the internal management. Then time focus. With financial, time focus means the historical concept. I told you about the historical concept in my previous video. The historical concept. If you want to understand the historical concept, there is another video I've made about historical. You will understand what it talks about, the principles of accounting. What the matching concept, what does it mean? The historical concept, what does it mean? The going concern, what does it mean? All those that are well elaborated in the statement, in the video. Then with financial accounting, it's mainly the historical perspective. What do I mean with historical? It uses the past information to guide the future. That's financial accounting. For example, in the balance sheet, a balance sheet is a going concern. That means if it's a going concern, the transactions on the balance sheet for this month will be an accumulation of transactions that were from the previous year. That's what I'm trying to mean. Then, if you go in management accounting mainly deals with future emphasis. What do I mean by future emphasis? For example, a cash flow. A cash flow tells you what is coming in, what is going out, there and then. If it's a month, it's a month. Then it also deals with forecasts. A forecast tells you what you're seeing ahead. That's management what? That's management accounting. Then the rules of accounting. I'll explain what the rules of accounting mean. Mainly, accounting uses GAAP, the General Accepted Accounting Principles, or IFRS. So I'll explain what these two mean and how they came about. But for purposes of learning right now, you just know financial accounting follows the prescribed formats. If the balance sheet is assets are equal to equity plus liability. That's it with financial accounting. Then with management accounting, they focus on segment reports. What do they mean? Let me say a cash flow or a balance sheet. Instead of taking a whole balance sheet, for them they will be like, management accounting, it will be like, we want that segment of May. How did we perform? That's what management accounting means. Okay, if it's a P&L, that's P&L belongs to financial accounting, but management accounting will want what was the revenue of May. You get my point? That's what they call segment reports. They don't need the whole thing. No, they just need particular parts of the report. That's what it means. So with a management report, for rules, they don't follow rules basically. For them, they deal with segments. For example, a revenue report, only revenue. It won't be with expenses. For example, an expenditure report, only expenses. It won't be with revenue. That's what it means. Then requirements. Financial accounting, it's a must. It has to follow external reports. Why? For purposes of tax authorities, for purposes of audit authorities. But with management accounting, it's not a mandatory. With financial accounting, it's a must because you have to be obliged to pay taxes. That's why these financial statements, when you go to these companies, you'll find those financial statements on the company's websites. It's a mandate to do it. But with management report, it's up to the company, do it or not. Then the subject. With financial accounting, the primary focus is on company-wide reports. How are we performing generally? I'll come and I teach you about what we call consolidated financial statements. I'll come and I teach them and how they are calculated and how they are done. Then, as I told you, with management accounting, the focus is on segments. If it's revenue, it's only revenue. If it's expenditure, it's only expenditure. If the liabilities, the only liabilities. If the assets, the only assets. That's what segments mean. They don't take the whole thing. No, that's not what management accounting does. They would want to know, okay, you give us our liabilities and see why are they increasing? What is the problem with the liabilities? That's management reporting, so that they can plan for the future. As I said, number 2, management reporting, it's mainly on the future. It plans for the future performance of a company or organization. So, timeliness. With financial accounting, they normally follow time. For example, a company, a balance sheet, it can be monthly. A profit and loss, it can be monthly. Or it can be annual. They are normally monthly reports and annual reports. So it's up to what the board of directors has agreed or what the accounting department has agreed to with the board of directors or the board of directors or the investors. But with management accounting, it doesn't have time. It does not need any time. The information is always there when the management needs it. If the management says next week we want a report from finance of expenditure, the expenditure report, you give it to them. In most cases, when they have monthly meetings, you give them to it. Once they ask, you produce the report. They don't have this monthly basis like financial accounting or financial statements, where you find a balance sheet, it's at the end of the year, where you find a balance sheet, a profit and loss, it's at the end of the year. With management reporting, it's ready. It has to be ready, or it has to be out when the management needs it. It doesn't have this timeliness of, no, we have to give a report at the end of the month, every end of the month. No, that's not what management accounting is all about. So with that, guys, I think you've understood. If you have any questions and more explanation on this video, let me know in the comments. I can explain it better. If you're not understood or if you want more notes, I can give you the notes. And if you're in need of any help, please let me know as far as this video is concerned. Yeah, that's it basically. So these are the major differences. They're actually 8, but these are 7, and these are actually 6. They're actually 7. Yeah, these are 6, but these are the major. If you get these, that's it. They normally ask 5 differences in an accounting paper. They don't normally. I haven't seen a paper where they go about 5 differences. They might ask 5, and then it's 2 per difference. 2 marks per difference. Those are 10. They normally give 10 marks on this number. So with these differences, that's it, guys. If you have any question, as I said before, please comment in the comment section below. Like and subscribe, and please share the video for your fellows to understand. These videos are basically for university students who are doing accounting, who are doing a course unit of accounting basically. And there are many university courses that do accounting. So please share the video if you have watched it. I know it's very productive because these things are the exact things they're asking in the papers. Thank you guys for watching. Let me see you in my next video. Thank you.